we've decided to reduce the policy repo rate under the Liquidity Adjustment Facility, LAF, by 25 basis points. We've also decided to reduce the cash reserve ratio, CRR, of scheduled banks by 25 basis points. This policy guidance will, however, be conditioned by the evolving growth inflation dynamic and the management of risks from the twin deficits.
So I think the Reserve Bank has taken a very balanced view, in my opinion. A reduction in the policy rate and the reduction in the CRR are aimed at stimulating economic growth and at the same time keeping inflation under control.
We feel that the economy is beginning to bottom out and that we hope that many of the steps that the government has taken will lead to a revival of interest in investment and faster movement of some of the big infrastructure projects.
After a 9-month wait, the Reserve Bank of India has finally bitten the bullet, cutting the repo rate and the cash reserve ratio by 25 basis points, but giving out a cautious guidance saying the space for monetary policy easing going forward is limited. How do we really read into the RBI's policy? Will the rate cuts help in reviving growth, or will inflation and the government's widening current account deficit continue to remain constraining factors for the RBI? That's our debate tonight on We Mean Business. Joining us on the show, Dr. Brinda Jagirdar of the State Bank of India on a link from Mumbai. Mr. P. Srinivas, the ED of the Bank of Baroda, also joins in on a link from Mumbai in our studios. Madan Sabnavis, the Chief Economist at Care Ratings, joining in from New Delhi. Didar Singh, the Secretary General of FICCI, and S. Sandilya, the President at the Society of Indian Automobile Manufacturers. We'll also get you a view on what this means for the real estate sector from Bharat, Mody, the CFO of Hubtown, later on the show. But first, a detailed analysis of today's decision from our financial policy editor, Ira Dugal.
After months of near desperate pleas from the government and certain sections of the society and the industry, the RBI has finally resented. They've actually given in on the calls of a rate cut. The repo rate has been cut by 25 basis points, which was the baseline expectation in the market in any case. That rate now adjusts downwards to 7.75%. The reverse repo rate and the marginal standing facility rate, which are now linked to the repo rate, will also adjust downwards. The surprise factor to an extent came in terms of the liquidity side, where the RBI has cut the cash reserve ratio by 25 basis points, bringing it down to a historic low actually of 4% on the cash reserve ratio. What the RBI has done, taking repo rate action and CRR action, is ensure that monetary transmission takes place and banks pass this down. We'll talk about that in a minute, but the RBI cumulatively on the liquidity side in particular has now added 1 lakh crore between September and now. There's been a change in the RBI's projections as well for this particular fiscal year. So for FY13 GDP growth, that's now being pegged at 5.5% versus 5.8% earlier. That's a realistic estimate and in line with what everybody else on the street is thinking. The inflation number is actually more interesting because the March end inflation projection has been reduced all the way down to 6.8% from 7.5% earlier, and it's that projected downward trend in inflation which is perhaps giving the RBI comfort to go ahead with a rate cut and also guide towards possible further action. Which brings me to the guidance. Let's see what the RBI is saying in its guidance. Very, very cautiously worded guidance as always. The RBI is saying there is an increasing likelihood of inflation remaining range bound. This provides space, although limited, for monetary policy to give greater emphasis to growth risk. Just stay with that for a minute, because when we questioned how much room there is, a natural question to ask the governor, he was very careful to say it's limited rule and the RBI would use their judgment very carefully in the timing and the quantum of those cuts. The policy, of course, can't de-emphasize inflation, so what they are very clearly saying is that the guidance will be conditional on the evolving growth inflation dynamics and also the management of the risk from the twin deficit, which is where the current account deficit in particular comes into play. Talk about that in a minute, but I do want to give you another sentence from the policy which has a slight dovish tilt, which is why the market is saying that maybe the RBI is turning a bit dovish, and that is this statement. They say that while the monetary policy stance has sought to balance the growth inflation dynamic through calibrated easing, it is critical now to address the loss of growth momentum without endangering external stability. So clearly gives you a sense that growth has been pumped up in the list of priorities for the RBI. Some of the other risks that they highlight right now for the economy, the current account deficit is the top of that list, with the current account deficit expected to cross 6% in Q3. That's definitely going to be a worry. Global risks, they say, remain elevated. There are supply constraints to inflation, of course. There is a need for a sustained revival in investment, which hasn't happened yet. And they also talk about the risk in the banking system. But the CAD, the current account deficit, is the top sort of risk out there. Keeping that and inflation in mind, here's what the governor had to say about the guidance and the outlook from here.
The normal expectation, the textbook, is that if you expect the CAD to be going up, you would want to tighten policy. Easing will lead to increase in aggregate demand, perhaps increase in exports, therefore worsen CAD. There is also the concern about how this might be interpreted by our external analysts, external interlocutors, and external financiers about how easing of monetary policy in the context of rising CAD might be interpreted. And what indeed it might do for flows are our flows, equity flows, or debt flows, and how interest sensitive they are. We have taken into account all this, including the implication of easing policy at a time of rising CAD, but taking an overall picture, balancing all considerations, we decided to ease the policy rate. If inflation eases further I mean more than we expect it to, and if CAD moderates further, by further I mean more than we expect it to, because in the fourth quarter, CAD might be less than in the third quarter, but it has to be significantly less, and we have to have low and sustainable CAD. So if inflation moderates further, CAD moderates further, there will be more room for monetary policy easing. But if they go along the currently expected lines, the space for monetary policy easing is quite limited.
All right, so very, very conditional guidance from the RBI, but there is a slight dovish tilt, at least that's our take. It'll play out in the months ahead. The big question now is going to be, are banks going to pass it on? And the answer there is probably yes. IDBI has already kicked off the rate cut cycle, 25 basis point cut in their base rate, and the deposit rate has been announced. Most banks we spoke to, most bankers who spoke at the RBI said that rate cuts will most likely be passed on, and interestingly should be passed on to the base rate rather than segmental easing. So that's definitely good news for all borrowers, whether it's existing or new borrowers. What is also going to be interesting is that this time around the sequencing may change. Lending rate cuts may actually come before deposit rate cuts because deposit growth has been so weak. So banks are not going to be in a hurry to cut deposit rates, but they may want to cut lending rates because they don't want to get uncompetitive in a tight market. What does that mean for banks? There could be a bit of pressure on margins, although that may be temporary. Here out are the top bankers speaking about their reaction to this policy.
There is a case for transmission this time for a simple reason that all along people have been waiting that the transmission happens when the policy rates are cut. Though policy rates in itself do not give any benefit to the banks, but the CRR cut coupled with the policy rate cut will bring liquidity into the system.
ऐसा करना ठीक नहीं है कि बेस रेट कट नहीं हुए थे. आज आप देखें अगर बेस रेट तो हर बैंक का जो बेस रेट है आज से 6 महीने जो पहले थे उससे काफ़ी कम है. तो दोनों तरफ से ये बेनिफिट पास ऑन होगा. कुछ बैंक बेस रेट करेंगे, कुछ बैंक पॉकेट्स में करेंगे.
There will be monetary transmission. So to get into details at this point of time, whether it will be base or whether it would be pockets would be premature. But I would say on behalf of most of us that there will be transmission.
You may find a difference in the pace at which the deposit rates move and the lending rates move. From whatever you've heard so far, I think this is the best time for the small depositor, because the indication that you're getting from everybody is that on the lending side there is going to be a transmission. Mm-hmm. On the deposit side we're going to watch the situation. So I think that's probably the best news that as of now the depositors or the small customers can look for. Clearly in the long term the banks cannot take an hit on NIM, and the lag will get adjusted.
I guess liquidity has been tighter than what the RBI desired LAF of 50,000 is, and that's probably the reason why RBI has decided to take a structural view of reducing CRR. I think they don't want to release too much at one time and then have to manage liquidity, which is why we've seen 2 CRR cuts of 25 basis points each. And I think, as everybody has said, more than the repo rate cut, it is the liquidity and the actions through CRR and OMO that are going to determine what happens in terms of interest rates from banks.
All right, with that, let's throw it open then to our panel. I want to begin with Dr. Jagirdar. Your first reactions, ma'am, on what the Reserve Bank of India has done, a little sweeter than expected perhaps, with the CRR cut coming in as well?
Yes, that's right. I think this is really a welcome move. And if you see, the governor said that the economy is clearly at a tipping point. And this is what he has, and by his actions, he has helped to really take forward this momentum and growth. The improvement in macro parameters that we have seen has really given policy space to the Reserve Bank governor to go ahead with the rate cuts. Inflation was a big concern, and inflation has come down from 8.1%, a peak of 8.1% in as recent as September, to 7.18% now. And within this, the core inflation has really softened to 4.19% from 7.99% a year ago. So this softening in inflation is what has given RBI space to move forward, because the concerns of growth were really there, and the governor had also been expressing his concern. And if you look at the IIP, the Index of Industrial Production, because industrial production has come in at just 1% in this fiscal so far, and the capital goods is actually contracting. So to reverse this trend and in sync with the momentum improvement in sentiment that we are seeing with the steps that the government has announced, I think together the steps that the Reserve Bank has taken today will really help to turn around the sentiment and improve growth in the economy.
India's #1 news app just got even better. Download NDTV's new app. Fully optimized for retina display, full screen view, faster response time, and Sudoku. NDTV's new iPad app. Download now.